Good morning, guys. This is Vineet from Transform Base and Blue Hive. And I think after a while, I'm coming back to you guys because over the last 12 to 18 months, we have helped so many clients and there are so many queries that we get asked. And there's a common sequence of questions and concerns that most people have because of lack of advice, lack of adequate information, from the sound bites they are hearing from other mortgage brokers, accountants, solicitors, etc., etc. So I thought this is good time around Easter break to spend some time on bringing some knowledge, insights from our experiences, our understanding of the complex ecosystems of corporate taxes, corporate laws, banking and financial. We go quite deep into the subject of banking and finance, and I think we just find opportunities more often than others, and we love to help many of our clients to build great wealth using property investing and maximizing their borrowing capacity. So let's get deeper into the subject of trust borrowing and how that could help you create better wealth and build a better portfolio. Question number one that I get asked quite often is, how is buying investment property under trust going to preserve the borrowing capacity? Brilliant question. I think I've answered this question many times in my previous interviews and the clients that I've spoken to. I'm kind of elaborating it again. So when you buy properties in an investment under a structure versus in your personal name, when you buy anything in your personal name, it's added onto your personal balance sheet. No lender in Australia can ignore what's on your personal balance sheet, whether it's your assets or your liabilities. They have to be included every time there's a calculation done around your borrowing capacity or around your wealth calculations, right? However, when you create a trust, and when I say trust, it has to be done correctly, the design has to be done correctly, and you need to go to the right lenders in the right sequence, which is supremely critical. But if you do that, then you actually create assets and liabilities off your personal balance sheet in a different entity, which is seen different to you. You're actually a director in that entity rather than a personal borrower. That is almost creating avatars of yourself, multiple avatars of yourself. And every time you go to lenders to kind of explain to them how you have been holding properties under different structures and what is the gearing under different structures. A lot of bank, even in current scenario, as per their policies, would allow an exception and ignore trust that we are not using for income and for liabilities. So critical is your trust have to be positively or neutrally geared. Another critical point is your trust structure has to be correctly designed, and the most important is you go to the right lenders with right information and right explanation in the right sequence. Hope this allows and helps you understand how trust borrowing can significantly boost your borrowing capacity. Now, as an example, a classic case study for you to understand this in very simplistic terms is, I've got clients who came to me with about $1 million borrowing capacity. Now think like this: if you have $1 million borrowing capacity, all you can buy in your personal name is about 2 or 3 properties depending on the value that you are able to squeeze in. But that's when you are going to exhaust yourself. You're going to hit the ceiling. However, same clients with me have actually been able to multiply that $1 million borrowing capacities with multiple lenders. They're now right now sitting on 6+ properties and still have enough borrowing capacity to buy more. So there are underlying principles in this whole process. The process is not simple, it's complex, but you need to speak to the right people with right knowledge to get onto this. If you do it correctly, an example, as I said previously, would significantly help you multiply your property portfolio, and responsibly and legally within the law books. So there is nothing dodgy here. Another question that we get asked is, please touch more on the pros and cons of trust, exit strategy, CGT, inheritance, negative gearing, deposits. So there are a lot of questions that we get asked, and some of them I cannot answer because I don't practice tax. I'm not a tax accountant. I'm a practicing accountant and a finance expert. So questions that I can answer is about using trust. Trust allows you to multiply your borrowing capacity. As I said, trust allows you to put expenses in a off personal balance sheet, as I said. So that means you could have liabilities in structures, but they do not get added to your personal balance sheet. That allows you to multiply your borrowing capacity legitimately. In terms of whether the tax implication of buying something under a trust is different to buying something in your personal name from investment properties perspective. The answer is no. The tax implications are pretty much similar. How about negative gearing? Do buying properties under trust allows you negative gearing? The answer is yes and no. So negative gearing, when you talk about negative gearing in very traditional sense, it means you are claiming your losses against your personal returns. Under trust, that's not allowed. However, you are able to carry your losses under the trust, and you're able to carry forward to a point when your properties become positively geared. At that point, before you pay any taxes, you are able to set off your losses. So yes, you are able to carry forward the losses. There is no extra tax that you pay unless you have been able to set off your losses. So it's all about timing. So instead of sugar gratification of claiming your negative gearing the same year, you almost wait for 3 or 4 years for your trust to become positively geared, and that's when you do it. However, in that process, you've almost multiplied your property portfolio by 3 or 4 times. What is it that you need to require as a fundamental principle when you have to be successful in this lending strategy under trust? So I think the fundamental and very critical success criteria is for you to be able to maintain your current income or continue to improve. You need to maintain or continue to improve your ability to draw savings. Your reliance on equity draw from your properties under your personal name has to become lesser and lesser. You need to speak to people who have the right knowledge and they guide you with the right set of information. That's supremely critical. A lot of people come to me and say, why do we charge fees whereas the rest of the broking industry is not? So the answer to that question is, we are brokers, but we are also accountants, and the subject that we're trying to solve for you is all about wealth creation using complex strategies. They are not simple, they are not cookie cutter. It takes time to draw the right strategy for every family. So what the conversation that I have for you may not be the same conversation for your friends or colleagues. Hence it takes time, and hence we charge. We definitely value our time, your time, and sincerity involved in this whole process. The end goal is to help you build better wealth through property investing. Another question that we get asked is, how about LVR requirements or rates of interest? Whether banks charge you higher rates of interest if you're buying under trust? The answer is no. So most lenders who are doing lending under personal borrowing, they go up to 88, 90%, 95% depending on what you are doing. For a common family in Australia, there is no difference in terms of the LVRs that you could achieve under the trust or outside the trust. It's likewise in the name of interest rates. Good lenders, and be it banks or non-bank lenders, they don't discriminate in terms of pricing. You get pretty much similar pricing. Yes, the lenders who are not comfortable dealing with this complex subjects, and that includes some of the largest lenders in the country, they would discriminate. But do we have to necessarily go to them? No, the answer is, I'm yet to find someone who has been able to exhaust themselves with the options. The answer is, ecosystem has more than sufficient lenders to deal with your problems if you do it right. Another question, and this is a classic case study that people ask us, give us an example of where you have helped families multiply their borrowing capacity. I think I've answered this previously, but I'll explain to you again. So I've got clients who came to me with about $1 million borrowing capacity and even less for some time, and all they could do in the right circumstances, going directly to the banks or through a traditional broking channel, buying in your personal name, you'll possibly max out at 2 or 3 properties. The same family, same clients with us are now sitting on 6+ properties and yet have the borrowing capacity to deal with. Critical thing to understand here is, your accountant is going to play a critical role in this whole process, and I get asked this question, how the trust is going to be self-sufficient, etc., to prove to the lender. Now, there are a couple of things. I'm not trying to give you tax advice here, but your accountant and your bank has a view on this. So one, your accountant might and should be looking at the macro fundamentals of the family. What's your overall income? What's your ability to deal with the debts, etc.? And that should allow them to give a fair bit of comfort to suggest that your trust can be sufficiently looked after, right? Now, I can't put words in their mouth, we can't coerce them, but that is something which is as a service available, It's built on trust, credibility, and your financial discipline. Likewise with the lenders, they also understand the nuances of trust lending, and they're relying on professionals to provide them adequate support and evidence so that you will not fall. Understand this thing very, very carefully. In this whole process, you have to be very responsible around your family, and you got to have the right advice. If you go down the path of greed, you are almost signing a bankruptcy, which you don't want to. So you have to be responsible towards your family, and you need to be on top of your cash flow. As long as your fundamental financial discipline is in place, you should be able to do a lot better under these structures. If you still have questions and you want answers to your specific family situation, please reach out, and we are here to help all our clients. Trust me, the fundamental philosophy of our business is, if it is not right for you, it's not right for us. Yes, we do appreciate sincerity in terms of how you reach us and how we try and help you. Thank you so much.